You have been lied to about tax brackets. I hear this at least once a month, usually from smart people who are otherwise great with their money. They tell me they turned down a promotion, or they stopped working overtime, or they refused a bonus. Why? Because they are terrified that earning that extra $1,000 is going to bump them into a higher tax bracket and actually lower their net pay. They think the government is going to punish them for success. If that is you, or if you have ever thought about keeping your income low just to avoid the taxman, I need you to listen very closely. Getting a raise never lowers your take-home pay. If it did, the entire mathematical structure of our economy would collapse. Today, I'm going to show you exactly how marginal tax brackets work, using a simple sketch I call the bucket method. By the end of this, you are going to realize that fearing the next bracket is costing you a fortune. This isn't just about math trivia. This is about your career trajectory. I have seen people stagnate their earnings for a decade because they misunderstood a simple tax table. They see a headline that says, "Top tax rate is 45%, and they assume that if they cross that income line, the government takes 45% of everything they earned. That is simply not true. We are going to debunk the biggest myth in personal finance. We are going to look at the difference between tax walls and tax slices, and I am going to draw out the numbers on screen so you can see, with your own eyes, that earning more money always results in having more money. We need to fix this mindset, because believing this myth is an expensive way to live. Before we start pouring water into these buckets, do me a favour. If you have ever been confused by a pay stub, or if you just want to keep more of what you earn, hit that subscribe button. It is the best return on investment you will get for $0. Alright, let's talk about the mechanism. The confusion starts because we use the word bracket. When you hear the word bracket, you probably imagine a box. You are either in the box or you are out of the box. You think, okay, I'm currently in the 20% box. If I earn $1 more, I move into the 30% box, and suddenly all my money is taxed at 30%. That is the nightmare scenario. That is what people think happens. But in a marginal tax system, which is what the US, the UK, Canada, and most of Europe uses, brackets are not boxes. They are layers. Let's visualize this properly. Instead of thinking about tax brackets as walls that you climb over, I want you to imagine a stack of buckets. Picture a whiteboard in your mind. At the very bottom, sitting on the floor, is a big plastic bucket. We will call this bucket 1. Above that, balancing on the rim, is bucket 2. Then bucket 3, and finally bucket 4 at the top. This is your tax system. Now, imagine your annual income is water pouring from a pipe at the ceiling. The water falls down and hits the stack. Gravity does the rest. It fills the bottom bucket first. It has to. The water cannot magically skip the bottom bucket and jump into the top one. It fills bucket 1 until it overflows. Then it spills into bucket 2. When bucket 2 is full, it spills into bucket 3. This flow is the key to understanding why you are never punished for earning more. Here is where the tax rates come in. Each bucket has its own specific rule. Bucket 1, the one at the bottom, usually has a tax rate of 0%, or maybe very low, like 10%. Let's say the rule for bucket 1 is 0% tax on the first $10,000. That means every drop of water that stays in that first bucket is yours, tax-free. It does not matter if you make $10,000 or $10 million. That first bucket at the bottom is always treated the same. Now, let's look at bucket 2. Maybe this bucket holds the money from $10,000 up to $30,000. The rule here is 10% tax. But here is the critical part. The 10% rule only applies to the water inside bucket 2. It does not change the water in bucket 1. The water in bucket 1 is already safe. It is sitting there, tax-free, minding its own business. So, let's say you have a really good year. The water keeps pouring. You fill up bucket 1. You fill up bucket 2. Now you are spilling into bucket 3, which has a higher tax rate. Let's say 20%. This is where the panic usually sets in. People think, oh no, I'm in the 20% bracket. Now I have to pay 20% on everything. But look at the buckets. The water in bucket 1 is still taxed at 0. The water in bucket 2 is still taxed at 10. Only the overflow, the specific drops of water that land in bucket 3, gets taxed at 20%. The higher rate only touches the top slice of your income. It is physically impossible for the top bucket to poison the buckets below it. They are separate containers. This is what we mean by marginal. Marginal just means the next one. The marginal tax rate is the tax on your next dollar, not your previous dollars. This leads to a simple truth. Earning more always fills the total stack higher. If you get a raise, you are pouring more water. Yes, that extra water might spill into a bucket with a higher tax label, and yes, the government will take a larger scoop out of that specific extra water. But the total amount of water left in your stack is still higher than it was before. You cannot end up with less total water by pouring more in at the top. The math simply does not allow it. Yet the myth persists. Why? Because usually we don't see the buckets. We just see a paycheck that feels smaller than we expected, or a tax bill that looks scary. But feelings aren't math. Let's look at a concrete numerical example to prove it. You might be nodding along thinking, okay Tom, I get the buckets. But there is a trap here. Even though the buckets protect your previous income, most people still calculate their taxes completely wrong in their head. They look at their bracket and assume that is their burden. If you think being in the 22% bracket means you pay 22% to the government, you are overestimating your taxes by thousands of dollars. And that calculation error is what keeps people poor. We need to run the real numbers to see just how big the gap is between what you think you pay and what you actually pay. Let's put two people side by side. We will keep the math round and simple. No specific country codes, just pure logic. Imagine a tax system with 3 buckets. Bucket A is 0 to 10,000 at 0%. Bucket B is 10,000 to 50,000 at 10%. And bucket C is anything over 50,000 at 20%. Now, meet person 1. They earn 49,000. They are right at the edge of that second bucket, just before the rate jumps. They are feeling safe. Then meet person 2. They earn 51,000. They have crossed the line. They are in the high tax bracket. Person 1 looks at person 2 and says, "You fool! You crossed the line. Now you're going to pay 20% tax, and I'm only paying 10%. I bet I take home more money than you." This is the conversation that happens in break rooms all over the world. Let's run the receipt. Person 1 earns 49,000. Let's fill their buckets. The first 10,000 goes into the 0 tax bucket. Tax is 0. That leaves 39,000 remaining. All of that falls into the second bucket, which is taxed at 10%. So 10% of 39,000 is 3,900. Total tax bill, 3,900. Total net pay, 49,000 minus 3,900 equals 45,100. Okay, simple enough. Person 1 walks away with 45,100 in their pocket. They are happy. They avoided the 20% bracket. Now, let's look at person 2, the unlucky one, who got a raise to 51,000. Remember, the myth says they should be worse off because they touched the 20% rail. Let's see if the math agrees. Person 2 earns $51,000. First $10,000, tax-free, just like person 1. The next chunk, from $10,000 up to $50,000, is taxed at 10%. That is a $40,000 chunk. 10% of $40,000 is $4,000. So far, they have paid slightly more tax, but they have also filled that second bucket completely. Now they have $1,000 left over. This is the only money that spills into the dreaded third bucket. That $1,000 is taxed at 20%. So they pay $200 on that last slice. Total tax, $4,000 plus $200 equals $4,200. Now for the net pay. $51,000 gross minus $4,200 tax equals $46,800. Let's compare. Person 1 has $45,100. Person 2 has $46,800. Person 2 is richer by $1,700. The raise didn't hurt them. The buckets worked exactly as designed. Look at what just happened. Person 2 earned $2,000 more in gross salary compared to person 1. They paid a little more tax, $300 more to be exact. But they kept $1,700 of that raise. Would you ever turn down an extra $1,700 just because you had to pay a $300 fee to get it? Of course not. That is essentially what taxes are, a processing fee on your income. The fee might get slightly higher on the last few dollars, but it never exceeds the value of the dollars themselves. As long as the tax rate is below 100%, earning more always yields more. And since no Western democracy has a 100% tax bracket, you are safe. The math holds up every single time. This brings us to the terminology that confuses everyone. Marginal rate versus effective rate. This is where the "I don't want a raise" myth gets its fuel. The marginal rate is the rate on the very last dollar you earned. It is the label on the top bucket. In our example, person 2 had a marginal rate of 20%. If they earned one more dollar, they would pay 20 cents on it. That is the number you see in the headlines. Marginal tax rate hits 20%. It sounds scary. But the effective rate is the one that actually matters to your bank account. The effective rate is your total tax divided by your total income. It is the blended average of all your buckets. And it is almost always much, much lower than your marginal rate. Let's go back to person 2. They are in the 20% bracket. That is their marginal identity. But remember, their total tax was $4,200 on $51,000 of income. If you pull out your calculator and divide $4,200 by $51,000, you get approximately 8.2%. That is their effective tax rate. Think about that difference. They are in the 20% bracket, but they only pay 8.2% of their life energy to the government. Why? Because the massive chunks of money in the lower buckets, the 0% bucket and the 10% bucket, dilute the average. The cheap buckets drag the average down. The expensive bucket at the top barely touches the average until you are making huge amounts of money. This is why people feel poorer than they are. They see the marginal rate and apply it mentally to their whole life. They think, I'm working for 80 cents on the dollar. In reality, they are usually working for 92 cents on the dollar. The system is progressive. It is designed to be gentle at the bottom and heavier at the top. But because we fixate on the top number, we make bad decisions. We assume the penalty for success is severe, when usually it is just a minor friction. Understanding the difference between your marginal rate, the speed limit on your last mile, and your effective rate, your average speed for the whole trip, is the difference between financial anxiety and financial clarity. You are almost never paying your marginal rate on your whole paycheck. So, how do you use this? Next time you look at a tax table, ignore the column that says tax rate for a second, and look for a column that says effective rate, or calculate it yourself. If you are debating taking a side job that pays $5,000 extra, don't look at your top bracket and groan. Look at the blended outcome. Yes, that $5,000 might be taxed at your highest rate, but the other $50,000 you earned is safe. The side hustle doesn't ruin your day job's tax efficiency. It sits on top. It is the cherry on the sundae. You pay a little more for the cherry, but you still get to eat the whole sundae. Now, I have to be completely honest with you. There is one specific scenario where the "I don't want a raise" crowd is actually right. There is a tiny hidden trap in the system where earning $1 extra can actually cost you thousands. It is not in the tax brackets. The tax brackets are fine. The trap is in the benefit system. We call it the welfare cliff, or the benefit phase-out. If you don't know where this line is, you can actually lose money by working harder. We need to talk about this exception so you know exactly when to hit the brakes. Here is the only time the math breaks. Governments often give benefits, childcare subsidies, healthcare credits, student loan relief, based on income thresholds. These are sometimes binary switches. For example, if you earn under $50,000, you get a $2,000 childcare credit. If you earn $50,001, you get $0. In that specific, poorly designed scenario, earning that extra dollar kills your $2,000 benefit. That is a marginal tax rate of over 100%. That is real. That happens. But notice what is causing it. It is not the income tax bracket. It is the loss of a subsidy. This is why people feel punished. They confuse tax brackets with benefit cliffs. If you are in a position where you receive significant government aid, you absolutely need to check the phase-out rules. But for the vast majority of people, those not receiving means-tested benefits, this cliff does not exist. There is another reason people hate raises: the bonus check shock. You get a $10,000 bonus. You are excited. Then the check clears and it is for $5,500. You scream. You think, they took half my money. I'm in a 45% bracket now. No, you aren't. What happened is that your company's payroll software is dumb. It saw that big check, multiplied it by 12, and assumed you were suddenly a millionaire making that much every month. So it withheld taxes at a millionaire's rate just to be safe. But, and this is huge, withholding is not tax. Withholding is just a deposit. At the end of the year, when you file your return, the government sees you aren't actually a millionaire. They calculate the real tax based on your real buckets, and they give you the difference back as a refund. You didn't lose that money, you just loaned it to the IRS for a few months. This comes down to loss aversion. Humans feel the pain of losing $1 twice as intensely as the joy of gaining $1. When you see a large chunk of tax taken out of a raise, your brain registers it as a theft. You forget that your net pay went up. You only focus on the fact that the fee went up. It feels unfair. Why should my effort be taxed higher than my laziness? It is a valid emotional reaction, but it is a terrible financial strategy. If you let that feeling dictate your career, you are essentially paying an emotional tax to avoid a financial one. You are choosing to stay poor to avoid feeling cheated. That is a bad trade. Here is the fix. Stop looking at the tax withheld. Start looking at the net change. If you take a second job and earn $1,000 and $300 goes to tax, you have $700 new dollars. Can you buy groceries with $700? Yes. Can you invest $700? Yes. Does that $700 exist if you refuse the work? No. The tax is just the cost of doing business with the world. You don't refuse to buy a car because there is sales tax. You don't refuse to buy a house because there is property tax. Do not refuse to sell your labour just because there is income tax. The net profit is the only number that counts on the scoreboard. I want to do a quick live calculation to hammer this home. If you have a calculator app on your phone, open it up. I want you to verify this with me. We are going to look at the beer money theory. This is the simplest way to explain marginal utility. Imagine I offer you a job moving a pile of bricks for 1 hour. I will pay you $100. But the government wants $30 of it. So you walk away with $70. That is $70 you didn't have an hour ago. Now imagine I say, okay, move a second pile of bricks. I'll pay you another $100. But since you've already earned some money, this second 100 is in a higher bracket. The government wants $40 of this one. Most people stop here. They say, that's unfair. I'm doing the same work but keeping less. And they are right. It is technically less efficient. You are keeping 60 instead of 70. But here is the question. Is $60 more than zero? If you walk away, you have $0 extra dollars. If you do the work, you have 60. Unless you value your 1 hour of time at more than $60, you should take the deal. The bracket didn't make the work worthless, it just made it slightly less profitable than the first hour. But profit is still profit. This is how wealth is built. Wealth isn't built by maximizing tax efficiency perfectly, it is built by maximizing net accumulation. The richest people in the world pay millions in taxes. They are in the highest brackets possible. Do you think they care? They care about the hundreds of millions they keep. If Jeff Bezos refused to earn his next billion because he didn't want to pay $300 million in tax, he wouldn't have the remaining $700 million. You have to be willing to share the pie to get a bigger pie. The I don't want to raise mentality is a poverty mindset disguised as tax savvy. It is cutting off your nose to spite your face. Don't fall for it. Now, does this mean you should ignore taxes completely? No. You should absolutely use tax-advantaged accounts like 401ks, IRAs, or ISAs to lower your taxable income legally. That is smart. That is optimization. But that is different from income suppression. Optimizing means I will earn the money and then hide it in a legal shelter. Suppression means I will not earn the money at all. One makes you rich, the other keeps you stagnant. Be an optimizer, not a suppressor. Fill the buckets, then use the tax code to drill holes in the bottom of the buckets so the water flows into your retirement account instead of the tax collector's bucket. So, let's recap the bucket strategy. Number 1. Your income is poured into stacked buckets. Number 2. The tax rate on the top bucket never retroactively changes the rate on the bottom buckets. The money you have already earned is safe. Number 3. Earning more money always, mathematically, results in higher net pay, unless you fall off a specific benefit cliff. And number 4. Your effective tax rate, the real percentage you pay, is almost always lower than the scary marginal rate you see on the news. The system is designed to always reward the next dollar of effort, even if it takes a slightly bigger cut of it. Don't let bad math hold your career hostage. Go for the promotion. Take the overtime if you want the cash. Accept the bonus. When your coworker leans in and whispers, "Watch out for that new tax bracket," you can smile, draw them a picture of some buckets, and tell them you ran the numbers. Or just nod, take the money they are afraid to take, and invest the difference. The tax code is complicated, but this part of it is simple. More is more. Don't overthink it. If this video saved you from making a bad career decision, let me know in the comments. I want to hear your tax myth stories. What is the craziest thing you have heard someone say about brackets? Drop it down below. I read all of them. And if you want to understand how to actually lower that tax bill legally once you get that raise, check out this video right here, where I break down tax-advantaged accounts. Thanks for watching, and I will see you in the next one.